You're watching Silver News Daily. Subscribe for more.
Did you know that silver is on the verge of a massive breakout that could make early investors a fortune? Francis Hunt, the market sniper himself, reveals why this undervalued metal might be the most explosive opportunity of the decade. We're talking about a potential surge that could surpass $50 an ounce, far beyond what most experts are predicting. And it's happening sooner than you think. So if you're holding on to gold, we're still on the fence about silver. You need to pay attention. This could be your last chance to get in before the real rally begins.
And you thank you for mentioning it, and what it means and what I think will transpire. Second of all, when you consider the great reserve assets of the last 40 years, and I'll highlight again that in 2020, August, we said the bond market, and was our first ever call on debt markets. We don't overcover it. We look at it as a benchmark of sanity, or for when the system reset is on, that it was turned from its 40-year bull market. And now you are in the escalator phase having ended, the elevator, the fast down phase having begun. And what's interesting, as I mentioned, is that other articles, some people will follow the likes of Zero Hedge, literally in 2024, had the same article insight of something we were saying 4 years ago and have repeated ad nauseum. So what does it mean that debt markets are over? Well, it was a reserve asset, particularly in the case of petrodollar, but not exclusively. Pension funds, everybody bought it. Why? Because you had 40-year, very stable, with little cycles, ups and downs, but very stable trends, generally going up in valuation. And at the same time, you got paid a coupon rate. So you had something that lent stability to your equity, think the 60-40 portfolio, where you shot for the moon with your Nvidia stocks, your NASDAQ or the .com, etc., all during that period. By being in the risky equities, and you had as your backstop, when the equities pull back violently, you would get a flight from that risk into the more stable debt environment where it could get bid up a little bit more, and it would compensate for the downside beta on your portfolio by the fact that debt would actually get some of those outflows from the fear of the equity market. So it was a stabilizing factor in equity down periods. And that was the basic thesis of a 60-40 portfolio. You needed to introduce some stability. Plus, it was also getting a small coupon rate. As the 40-year of bull market ended, we started at rates of Volcker peaks in 1980. And those rates continued to come down. So the coupon rate you got less attractive, but you continued to get the steady capital growth. What's ended up happening since that call in 2020, and now many other commentators realizing that, is you no longer get stability with a bond segment to your portfolio. The collapse in the debt markets from the blow-off high that was induced by the fear in the CV19 March 2020 events saw a blow-off. And
let's dive into what's currently driving silver's price movement. Recently, silver has surged to $31.74, fueled by falling U.S. Treasury yields and a stronger risk sentiment in the market. This upward trend has the bulls excited, and technical indicators like the Relative Strength Index, RSI, show a clear breakout, pointing toward further gains. Analysts are eyeing key resistance levels around $33, and some even predict it could reach $35 or higher in the near term. But why is this happening now? What's different about today's silver market compared to the past? The answers lie in the technical patterns emerging and the broader economic shifts taking place.
The American farmers were coming to New York City, much like the French do at a drop of a hat in Paris. So that's how bad it had to get to do that. And he turned up the pain to try re-establish and devalue the debt. When he raised the rates that far, what he was actually doing is devaluing the debt asset that had been raised and given on expenditure to the military-industrial complex to pay for the Vietnamese war. So see it in that light. And that's all been passed on you, and that debt is still there being rolled and continues to grow all this time. Then we had the financialization of everything. During this phase, we had globalization that kept inflation down. You had gold being demonetized. You had everybody getting into more finance, balloon payments on cars, only buying 40% thereof or 50%, all of this, oh, we don't need gold anymore. That was right the way into the dot-com boom that many remember, and that was literally tech dominating everything, and gold's, the legacy pet rock for old guys. Then we started, because of the debt levels that came with the recession of the dot-com, to see gold outperforming. Similar trajectory, same time frames, 1980. Silver bottomed a little earlier, but stayed in a stall box, while gold had a bit of a V bottom. So you can see they're clearly part of the same category of precious metals. Anyway, getting up to here, 2011 high, we recall that. I've referred to it regularly as this was a truncated bull that never was allowed to finish what it was starting. And that was because quantitative easing came in, we loaded all the debt, but by buying that more time, they almost made the debt an even bigger problem. So the subsequent pullback was not near as far. And when China became Shanghai Accord indebted, 2016 over here, we saw the debt issue reemerge, and we had the run to 2020, which was $2,075 for gold at that point. In that, this is a half, so this is H2. Each one is a quarter. It's not the exact day. It was the second half of the year. And silver was following the exact same route. It was round about there. It got its pants on and started to follow gold. Then it got stopped. We then went into a holding period for quite extended time frame. Down, down, down. And in fact, we started to bottom at July 22 again. But what you'll notice is the lows are getting very steeply higher, and the bandwidth to pull us down in the gold's performance relative to the CPI and silver's performance relative to the dollar was getting ever less. So the key point that brings us back to Tyler's question is, you have just triggered on gold in this first July 24. Remember, it's not on that specific day. We're talking about the first half, the second half of this year. This is a 2024 event. You have just triggered what we call the HVF pattern, a macro squeezing pattern.
Now, let's dig into how the Federal Reserve's recent policies are setting the stage for silver's explosive growth. Last Friday, Jerome Powell, chair of the Federal Reserve, signaled a shift in the central bank strategy, stating that the time has come to begin lowering interest rates. The markets are buzzing with anticipation, expecting a cut of at least 25 basis points, possibly even 50 if economic data shows further weakness. Why does this matter for silver? Well, when the Fed cuts rates, it causes bond yields to drop, making the U.S. dollar weaker. And when the dollar falls, commodities like silver typically benefit. But there's more. Negative real interest rates, which occur when inflation is higher than bond yields, are especially bullish for precious metals. This environment is like rocket fuel for silver, and we're already seeing the impact. Gold has recently hit all-time highs, and silver, which often follows gold's trajectory, is catching up fast. In fact, in past cycles when the Fed aggressively cut rates, silver saw gains that outpaced even those of gold. So could this be the start of another historic bull run for silver? If the Fed continues down this path, all the signals point to a massive upward trend.
That comes across like that and across like that, and you've finally taken out that third high. You are looking at a single candle that's in this 6 month that represents the triggering event of what will be embarrassing, I expect, even the 80s run. So Tyler should not want to miss these candles over here. And the problem with day trading is sometimes you miss the big move if you're not always in. Look at those candles of movement for gold over there. A lot of them come a little bit later in the trend, but you also had super big ones there, super big ones there. These are huge, huge moves. At the low point, you're at about 0.93 in valuation divided. That's a bit of a weird number. Don't over focus on it. Just look at the multiple. Today, you're at about 8.3. The target is 52. So just think 8 to 52. You're looking at another 6.5 times multiple in the performance of this metal relative to the CPI. On gold, on silver, on the other side of the chart, it's even easier. Again, we had a fake trigger. Silver has a little bit of a higher beta, stepped over the line, pulled back, and now you are reasserting in the red circle again to the upside. This is an incredible target, and we would expect it to be overperformed too. So this is a 56-year, my lifetime, my infancy to standing here today with you, setup. And both are very, very similar and recognizable, which shows you're looking at brothers and sisters or uncles and nephews or nieces, however you want to genderize it. But this is a triggering event here in silver, as it has already proven to be in gold. And we took out that capping descending grind line, and we took out that third high. The move has begun. Sometimes you just have to make sure you are in something for the whole range. Curb your trading instincts. You need to be investment long. If you get leverage long, you get more nervous. Every pullback becomes an event. What do? If you get in at a bad entry.
Beyond monetary policy, let's explore one of the biggest drivers of silver's value, its industrial demand. Unlike gold, which is primarily a store of value, silver is heavily utilized in various industries. Approximately 60% of silver's global demand comes from industrial applications, and this is only expected to grow. The rise of renewable energy, particularly solar power, is a key contributor. Silver's unmatched electrical and thermal conductivity makes it an essential component in solar panels, and as global investment in solar energy skyrockets, especially in China, which dominates the market, silver demand is set to follow suit. In fact, by 2030, the demand from the solar sector alone is projected to increase by nearly 170%, consuming about 273 million ounces of silver annually. And it doesn't stop there. Silver's role in emerging technologies like 5G, electric vehicles, and even advanced battery systems is becoming more significant. Samsung, for instance, is developing a new generation of solid-state batteries that incorporate silver, promising a massive boost in efficiency and durability. If this technology takes off, it could mean an even greater surge in silver demand over the next decade. So what does this all mean for investors? As industries clamor for more silver, the metal's price could experience an unprecedented climb. The question is, will you be positioned to benefit when it happens?
You could get near a localized high and you get a pullback. You could be shaken out. You can lose money in a bull market trading long. And the key thing is money management and sizing that will undo you. So my personal opinion is, Tyler, just don't miss the move. Be investment long, your largest part. Be very low leverage at select moments if you know how to trade, position size, and money manage. And that's what the HVF method is. The final answer for him, because I'm answering quite lengthy here and I don't want to overstate, we'll come back to the yield curve. Let's just go here and put in gold. I'm actually saying to all your viewers as well, because we spoke about short time, is it a trade? Will it pull back? It's still part of the question that was put to us. And we're saying there's a critical moment for gold coming up right now. Let me wipe my face a little bit. There's a critical moment for gold coming up right now. It's either going to be something of an upside move, and we're basing out a lot of times here, and then we're going to go and put a third high and continue to the upside, or we will fail and run that low. If we run that low, what's the number? Let's give people values on the short time frame. So remember, this is a totally different discussion to everything I've just said, which is the macro. This is now, what about just in front of our face, literally at the moment? And I'm saying it will be negative for gold if we were to run this low here, which is at 2,624. So I think you're looking at a more sustained pullback if that happens. However, I'm not calling that until it happens. There's been a lot of dollar strength brought on by the rates going back up. And we need to talk about that, Elijah, but I'll let you bring me in on that one because, as I say, I've been a bit long form here. But this is a critical moment, and I still don't rule out that we move back up to the 266s and end up with an upside break because gold is being accumulated. But we have to see, and there's always a level where you've got to accept you're wrong, and I just gave it to you.
Now let's turn to another critical factor pushing silver's value higher, the global accumulation trends. Around the world, key players like India and China have been dramatically increasing their silver purchases. India, in particular, saw a surge in silver imports this year, with February alone marking a 260% jump compared to previous months. China, too, has been stockpiling silver for its industrial uses, particularly for solar energy and electronics, where it dominates the market. What's important here is not just the raw demand, but the scale of it. When nations like China and India start aggressively acquiring silver, it sends a clear signal to the rest of the market. This trend is mirrored by institutional investors who are turning to silverback ETF. These funds saw inflows of $300 million in July alone after a period of outflows, showing that big money investors are waking up to silver's potential. The buying pressure from these institutional and national players is contributing to a perfect storm where silver could soon experience a supply squeeze. And when demand far outweighs supply, you can guess what happens to the price. So the big question remains. With countries and investors snapping up silver at unprecedented rates, how long before the price jumps to reflect this frenzy? Are you going to get in before the rush or risk missing out as silver prices soar?
Important and valid point, and thank you for bringing me in on it, because in fact, I'm going to go out a little bit on the time frame before I drill down and show you the current pattern of activities. This was the final capitulation. So this isn't got valuations of the 10-year. This is the yield. So everything is inverted. If you wanted to see how bonds were doing, and I had to do this for someone else because not everybody understands the history of bonds. Bond was multi-year, slow, steady bull market. So it's essentially the inversion. A simplification is the inversion of the yields that go on the 10-year. And there's your blow-off event. Think dot-com boom for stocks. Very similar. Final, everybody got to be in. Everyone was buying bonds. There was such a reason, so much fear. The risk-free trade was to get into debt, and that's what happened. Now you can see what I was saying about its loss of stability as an instrument. So if we now go back and just revert it the right way around and answer your question on the 10-year, what we're actually seeing is, and what we suspect, hence that 40-year bond reversal call, and the fact that it's an elevator to the downside rather than an escalator, is that we expect interest rates to continue to spike. And you can see you've taken out previous highs, that this was a trend change event. So taking us into the daily and having a look at a smaller time frame will bring a lot of perspective to this. We've had the whole talk about cuts and all of that, and you had the rates come down a fair bit from up top there, down, and then you had a spill down, then we got the half cut, you're down here. And what's actually happened is they came in non-farm payrolls with a blinder of a number, and CNBC is obviously, I expect, trying to fluff the Democrats up a little bit and show how strong the economy is going into your election. You mentioned you would have some questions about the election. That's the politicization of data. And when you read the likes of Zero Hedge articles or others, a large part of that huge winner labor number has actually come out of government hirees. And that, as you're probably aware, for GDP is non-productive. These are people that need, out of productive people, to pay their salaries, pay their pensions, pay their perquisites, and everything else that they live. So these are takers. Yes, they provide a service, kind of like you need a referee in a football match, but you don't have 30 referees all on $10 million salaries, because then the players stop getting the money. It's about the sport. It's not about the officiating. And that's how I view government. And what's actually happening is we're recruiting more referees and the players are starving. And that's not typically how it goes. So what we've seen is a move up, and this is a classic falling wedge structure. And we've spoken on this channel before. Some will recognize this because we often talk about the magic of three impulses. Even on wedges, this applies. There's your impulse one. Here's your more bloated, typical impulse two. And what we expect is going to happen is that you're going to continue to make a move in and around to the higher side here. And then we will get recession fears again, concern fears. Maybe it comes after the election and you'll get another sell-off period, either to the halfway mark or a full cycle to the down. However, later, and that's not too far off.
Let's dig into the gold-silver ratio, a key indicator that shows just how undervalued silver truly is right now. Historically, the ratio of gold to silver prices has been around 4 to 7:1 in the 20th century and ranged between 50:1 and 70:1 in the 21st century. However, as of today, the ratio is sitting at a staggering 86:1, meaning it takes 86 ounces of silver to buy just 1 ounce of gold. This is well above the 20-year average and signals a major disparity. What does this tell us? When silver is this undervalued compared to gold, history has shown that it's only a matter of time before it catches up. Analysts from Sprott Asset Management emphasize that with gold currently trading above $2,500 an ounce, silver should logically follow suit and rise well beyond its current levels. They even suggest that if the gold-silver ratio returns to its long-term average, silver could break through the $1.35 mark. And if bullish momentum continues, $1.50 or higher isn't out of reach. The gold-silver ratio isn't just a number, it's a signal. When it's this high, it indicates that silver has room for a substantial climb. The market dynamics are ripe for a correction, and when silver breaks out, it often does so explosively. The only question left: are you positioned to ride the wave when the ratio reverts to historical norms, or will you miss out as silver makes its move?
But it's not next week or even next month, but it could be December, it could be January. We break out of falling wedges, typically to the high side. And that is going to be debt concerns. You can't keep issuing the debt and no one's going to keep buying it. And if you have a look how markets move, there is the big bull market for the bonds that brought us up to around this level. And now we're in the sideways market. Yes, there's been further upside. We called this 5%, by the way, on your show. People should go look at the legacy ones. We said you're going to squeeze higher, even though everyone was on pivots. There was this W bottom over here with this target. These lines have been here forever. And we said after making the technical 5, our target was about 4.9. It's invariably going to run the key number. You're going to have a pullback and churn. And that's exactly what you're getting. But what you're getting is a continuation upside pattern as part of that pullback and churn. So actually, for all this near recession talk and landings talk, soft, hard, or none at all, etc., you actually haven't come back that far on the debt market, and you're in the staircasing phase where you're largely going sideways. And our prediction is that in given time, even though you will probably go one more time lower, the breakout on the medium longer term frame is to the upside, and we'll be drawing another one of these blue boxes heading up in this direction in due course. So that actually points to problem for real estate, refinancing, problem on car payments, distressed credit cards, all forms of debt instruments turning into a rout. And the second stage is worse. And for those of you familiar with Elliott, even if you take this as leg 1 and this is kind of pullback counter trend leg 2, it's usually the third leg, which is again to the upside, that has the biggest 61.8 plus the previous leg's move. That is devastating for the way that all economies, because this will go universal, especially if it's happening in the US debt market, it'll go universal. During this period, if rates get disorderly, the dollar will spike. So this was a period of dollar strength because the Fed and the USA had to stay out in front on rate rises. And you saw what happened to Britain when they didn't match them. This sideways period, we've actually had the US cut, and you've had the UK and Australia saying, I'm not sure we will. You know, it's kind of soft and we could cut, but one of them actually said the quiet part aloud in the UK, that's Bailey. We're not sure, we don't want to test what the market will take. What that actually is saying is, if we drop rates, we're saying our bonds are worth more. And who's going to come in and buy it? And in actual fact, there was a tweet today where the Bank of England has said they are going to match banks' bids in the debt market. Why are they needing to do that if there's sufficient demand? Everything I'm telling you about the debt system being incredibly precariously upheld and being the thing so few people understand. I will pass you an audio boom link, ref the rates and the valuations, how those are inverse, if you like, in the notes for anyone who's like mystified and bonds are a new thing to watch. And I'll pass it to you to share if this goes recording as well. To guys on the live stream, we'll tweet it out as well.
Shifting our focus to the global stage, let's talk about how geopolitical tensions and economic instability are driving up demand for silver as a safe haven asset. Traditionally, when global conflicts intensify, whether in the Middle East, Eastern Europe, or other regions, investors flock to precious metals to shield their wealth from market volatility. While gold often gets the most attention, silver benefits from the same trend, offering a more accessible and affordable hedge against uncertainty. Recently, geopolitical risks and economic instability have heightened, prompting central banks and large investors to increase their holdings in precious metals. As these entities stockpile gold, silver follows closely behind, not only because of its safe haven appeal, but also due to its industrial applications, which make it a dual-purpose asset. The ongoing conflicts and economic uncertainty create an environment where silver, like gold, becomes increasingly attractive as a store of value. Now, with these geopolitical forces showing no signs of abating, we have to ask, could these tensions be the catalyst that pushes silver prices to new heights? As central banks and investors continue to hedge against global risks, the silver market might be on the brink of a surge. Are you prepared to capitalize on silver's dual role as both an industrial and safe haven asset, or will you wait until it's too late?
The worst thing is to be sounding like a mega black pill doomer, but if it's a dark phrase, remember we had the Goldilocks economy where we could continue to print and run high liquidity, and we were globalizing, and the core CPI stayed really low because everything was moving to China, Taiwan, Vietnam. Manufacturing was being hollowed out. You get a once-off gift of that. They ran interest rates too low. They increased debt and financialization. Everybody's average expenditures for things weren't going up at the typical inflation rate because you got this offshoring benefit. And now we have, that was the day where we feasted and we drank and we partied. And now you have the morning after with the hangover. And, you know, if you take heavy drugs, you're going to have heavy hangovers. And we're going to have the mother of all hangovers. So I'm not going to sugarcoat it if that's the truth. I'm assuming everyone's red-pilled enough to take the truth. So what do? Do you fall in a heap and weep and get totally psyched out? No, you preserve your wealth, and gold and silver, precious metals are absolutely going to be a cornerstone of that. You have to get out of the debt markets. You have to prepare or insulate your way the best way possible against an interest rate spike. Even though there's going to be up and downs and we're in the sideways period for a while more. I can't tell you whether it's 6 days, 6 weeks, or even as far as 6 months they can pretend. But I can certainly feel that there is a crescendo coming for this October period. Banks will be compromised. The possibility of loss of all deposits will be in there. We're talking a kind of an FTX experience for everybody. Imagine that. And the bailouts, the FDAs, the deposit schemes are there for one bank failure where the rest are paying a premium to make clients whole. There is no insurance that insures the world. There is just no insurance. And when you see the size of their funds, you will know that they're not even a little pippy in the ocean in terms of coverage. So forget about, don't worry, government will make me whole. Government is not your friend in times like these. They are going to come for taxation. They'll probably want you to register your gold. I've warned of this before. And we had controversial comments. I think it was about a year and a half ago when I warned that just buying the gold isn't enough. You know, you might need to bear in mind how much of it will go black when they come to register. And I started putting forward all of these things, and they could even make it illegal, and they could at the final stage even come for confiscation. And now people said, he's just doomer, scaring us all. What did you see coming out of Israel? I don't think we've spoken since that. They will make gold ownership potentially illegal. So when everybody is doing their damnedest to survive this, they want to corner you. They need you to be a UBI serf. because that is the ultimate control. We're going into a period of totalitarianism. There is nothing good that comes out of a debt collapse for any of us. I don't celebrate it. I don't get glee out of it. There's going to be a lot of social hardship. There are going to be a lot of people that are going to be reliant on
One of the most critical and often overlooked factors influencing silver's price is the ongoing supply deficit and the possibility of market manipulation. The silver market has been in a structural deficit for 4 consecutive years, with demand consistently outpacing supply. In 2023 alone, the market recorded a deficit of over 184 million ounces, and experts predict that 2024 will see an even larger shortfall of 215 million ounces. This supply crunch is largely driven by surging industrial demand, particularly from the photovoltaic, solar sector, electronics, and electric vehicles. However, there's another layer to this story: market manipulation. Over the years, there have been allegations of major financial institutions suppressing silver prices to keep it undervalued. J.P. Morgan, for example, has faced multiple fines for manipulating the precious metals markets, leading many to believe that silver's true value has been artificially held back. But as physical demand for silver continues to grow and supplies dwindle, these manipulation tactics could become unsustainable. Imagine what happens when the true dynamics of supply and demand finally take hold. Silver prices could spike rapidly, breaking through decades-old price ceilings. So, with the market already in a deficit and manipulation cracks starting to show, are you prepared for the surge that could occur once silver's true value is unleashed?
that is typical of trend end and the subsequent very harsh smashdown. So since I think we've referred you to our Substack as well, where we show our debt up and all of these things down, and how much the debt market, the US debt market long-term came down, and it lost 45% from its blow-off high in March 2020 to the lows not so long ago, 2023, etc. So what the thesis is where's the stability? This thing doesn't perform wild cards to the upside. I'm not getting the high beta to the upside, but it was saving me a little bit in the bad years in the equity market. Now it's the problem. And it can lose 45% in 2 or 3 years. That's ridiculous. It's not giving me the growth on the upside for the last 40 years. It's incrementally. It's been a stabilizing factor. So what I am, my thesis, when you ask about where are we with the gold and what is it, you have one reserve asset that was for the petrodollar and pensions and everything that was UST T-bills that's had a 40-year bull market to establish that, paying a small coupon that got ever lower, but continuing to give you capital growth in a very slow marginal manner. It no longer is. Its rival is gold. So in the death of the USDT markets, the loss of its stability, contribution to portfolios, all portfolios, in my view, should cease to have bonds, because the reason for their original existence as a stabilizing factor and counter trend to down equity years is now gone. And so that asks the big question, what do you replace it with? And what we're actually seeing is that the central banks are voting through the charts in exactly what they're doing. And the replacement is that thing that allegedly was a down point, pays no interest. Well, you aren't getting much anymore. The inflation rate is way beyond that coupon rate. And in actual fact, you have continual is nobody's liability. And there's no possible default in holding that physical gold. It is truly scarce, can only be coming out the ground between 1% and 2% per annum. And yet you have proliferation on the T-bill side that is at $1 trillion at a new rate of 81.5 days, come down from 100 days. And actually, in the last 6 days of September coming into October, you did 345 billion of new debt. That's 1/3 of a trillion, more than 1/3 of a trillion in 6 days. So if you Chinese mathematics that out, it just spiked. I'm not saying it's going to continue at that rate. It would only take 18 days for $1 trillion. Now, again, as I say, I'm not making that as a prediction, but that is an accelerating proliferation of an asset that less and less people are wanting, with the golden alternative sitting there and moving up in price. We have only just begun, Elijah, and this is the most exciting point, and people need to understand it's the failure of the debt markets that will be the turbo juice for the precious metals markets.
Let's turn our attention to the technical analysis and long-term projections for silver. These are crucial for understanding where the price could be heading. Technical experts have noted that silver has formed a long-term bullish pattern that resembles historical price movements seen in past major rallies. Over the past century, silver has shown two key patterns, one from 1919 to 1968 and another beginning around 1980. Both patterns exhibit a cup formation, which technical analysts interpret as a powerful indicator for future price increases. The difference this time, however, is the scale. The price movement in the current pattern has outperformed its historical counterpart significantly, suggesting that the upcoming breakout could be much larger. Analysts like Hubert Moulin predict that if silver's current performance continues to follow this long-term pattern, the metal could experience a rally that outpaces anything we've seen in the past 50 years. Some even estimate that silver could surge to $50, $75, or beyond in the next few years. The technicals are aligning, and the fundamentals are there, so the question becomes, would you capitalize on this opportunity before the breakout occurs, or will you wait and miss out on silver's potential for historic gains?
A new CBDC UBI-based system, and they're going to resent you because the weaponized media will make them resent you for having planned for this. And the capital gains taxes after the registrations on the blockchain with an NFT of all your holdings, otherwise a 20-year prison sentence and a god-awful fine. All these kind of things are absolutely, unfortunately, potentially on the cards. So there is a lot of doom in there, but that doesn't stop you for aiming to do the right thing, being a principled person, looking to help other people and doing your damnedest to escape. And you may have to reach a point where you've got to decide whether you'll have any black gold that is unregistered, despite the threats that will be put your way, in a bid to preserve your legacy and your family. And you're now playing for generations beyond you, because I don't know how long a totalitarian government can exist. Once they're in power, they're pretty hard to shift. You're talking about surveillance finance, surveillance eavesdropping, surveillance everything. So it's difficult to see positives, but you just recognize that you were born to live in these times, and you need to be a leader and you need to be bold, because the bold, there will still be opportunities. There will still be other places. You have to consider the unconsiderable. For some people, I suggest you need to think about moving. The Western nations are in disarray and are in the downward trend, and nations you used to look down on might be better host nations for you. There's all sorts of things to consider, and it's a big job, but just do one thing each day towards giving yourself optionality, passports, tax residencies. I think taxation planning is going to be one of the most important, and they are coming for all of those things, but there's certain things that can't get grandfathered, that once you're in, you're in. And that's going to be super useful. The unrealized capital gains, the Democrats already floating this as the future Communist Party, that is literally confiscation. Because who determines valuation? We need money. They are not going to be able to raise the same money in the debt markets. So what are they going to do? Reduce services to you to reduce the bill and tax you further. They need more money from you for less service offerings. Your trash won't be collected once every week. You'll be collected once every month. Your policing services will have 2 guys and a walkie-talkie instead of 6 squad cars, or who knows. That is all what is potentially coming, and unfortunately you're going to have to prepare for it. You might need private security, all these things. You need to build wealth. The best thing you can do to preserve and build wealth is precious metals right now, and all that optionality of reset planning that themarketsniper.com thinks about all the time, is game theorying all the time, is making horrible suggestions that later turn out, unfortunately, to turn out potentially true. You're seeing case studies in the smaller nations, like you're seeing in Israel now on this discussion on the ownership of precious metals. Start your planning like it's happening. And hey, if we're all wrong, you've overplanned for a crisis that hasn't come. That means you protected your family in spite of everything and all the attack vectors based on it.
Everything we've discussed, rising industrial demand, geopolitical tensions, central bank policies, and the ongoing supply deficit, all points to one conclusion. Silver is on the brink of a historic breakout. The undervaluation shown by the gold-silver ratio, coupled with the technical patterns emerging in the market, suggests that silver is set to explode in value. Analysts are not just talking about small gains. They're predicting that silver could reach levels we haven't seen in decades, possibly surpassing $50, $75, or even higher. But it's not just the technicals and the fundamentals. This moment is about timing. With the Federal Reserve expected to continue rate cuts and geopolitical risks mounting, silver's role as both an industrial and safe haven asset becomes even more critical. When the silver market catches up with the realities of its supply-demand dynamics and breaks free from any manipulation, the price surge could be swift and dramatic. For investors, the message is clear. Getting positioned in silver now could be the opportunity of a lifetime. Don't wait until the price soars and the supply tightens even further. Act now before the market fully recognizes the value of this undervalued asset. And remember, this isn't financial advice, just a perspective on one of the most compelling opportunities in today's markets. Be sure to do your own research and make informed decisions.